Hello, my name's Chuck Evans, and I have David Tinsley with me, and we're with Lenders Cooperative. And this is the 30 at Noon monthly webinar series. This particular program is designed not to replace the good classes that NAGO offers and NADCO offers, or even the training on demand that the SBA offers. But what we like to do is to bring you industry stakeholders every month that can share some information that helps you just do a better job. So this is a live webinar, but because of the holidays, we're going to record this and send it out. So I guess it's a podcast. Uh, our guest today is Cory Jones from Lumos Data. Welcome, Cory.
Hey, Chuck, happy to be here.
That's great. We are going to talk today about emerging risk. David and I were at the last conference and we were talking to some of the folks at the Office of Credit Risk Management, and we have record levels of SBA lending this year. What did we do? $32 billion or more?
Yeah.
And that's all they talked about. But when you talk to the folks at the Office of Credit Risk Management, they mentioned emerging risk. So we're going to talk a little bit today about default rates. Cory's going to get into some information from Lumos Data. We'll talk a little bit about what I've heard Okram has seen when they've come out and done reviews, and maybe talk about some solutions. So Cory, I'm going to kind of turn it over to you if you don't mind.
Yeah, thanks, Chuck. So just a little bit more about Lumos Data, if anybody's not familiar with us. So we are a data analytics company. We've compiled the last 30 years of SBA data. So that's what we're going to be looking at today, and primarily that actual default rate. So we classify that one as 60 days past due. And I know there's a lot of talk in the industry with, oh, default rates are rising. Fiscal year 2024 is going to be really bad, and that's actually, it's true. We did see an increase in default rates. So just on the dashboard that you're able to see on the screen, if we look at rates increasing from fiscal year 2023, we had an overall for the entire SBA portfolio. So it's just under 300,000 loans on the book. We had a 2.77% historical default rate. That grew to 3.69% in 2024. So that's fiscal year 2024. Just again under that 300,000 loans. So the ones we put on, enough of those paid off, but really some decent growth overall. Chuck, David, thoughts on that?
One question that I had, because people felt that the default rates were low because of the pandemic and the support that we had, but the loans that you've seen today, where it's gone up, it's a result of post-pandemic lending, a good bit of it. Am I correct?
It's really both. That's actually a great point. So this bottom right-hand side is going to be a vintage analysis, and that's really what I think we all thought, right? We thought, new SOP changes, there's been more small dollar loans, but actually the data is proving that it's not just that. And then one thing we'll look at here. So along your left-hand side is going to be your note of fiscal year, so when the loan was produced, and then the performance period along the right-hand side. So from an early default risk standpoint, loans that were produced in 2024 had a 0.88% default rate in 2024. If you go back to pre-pandemic, you're at a similar early default rate. You're actually higher in 2018. So we
Wow.
haven't seen that risk yet from an early default. And this is all loan sizes. We can filter down to smaller loans. But the other thing that was really interesting, and I know these loans are older, so they have a higher likelihood of default just because of age, but the riskiest or the most impacted areas of the vintage was actually 2018 and 2019, almost a 5.3% default rate compared to 2022 4.85. Again, it's a newer loan, so that might pan out that in year 6 or 7 for them they will have a higher risk, but it really does seem like a lot of that risk was just kind of kicked down the road here in 2020 and 2021 and 2022 with all of those subsidies. So we've been very interested just at what the data has shown, that yes, it's new loans, but it's also legacy. It's not just those new loans.
So you've supported some of those borrowers through the pandemic, and now we're starting to see a little bit of a negative trend.
Exactly.
Okay.
Yeah. And I mean, if we wanted to drill into just loans under, let's say, I don't know, 350,000, just because I know
Look
that's
at that. Yeah.
the piece that people like to look at. So we'll go 350,000, apply, and we'll look, and it was surprising, right? Because we do hear it from our customers, from our partners, that they are seeing higher early default rates. They are seeing more risk in this portfolio. And that is true, right? We went from 3.2% overall default rate for loans under 350,000 to 4.17. So it did go up, a little bit higher than the average, right? The average was 3.69%. So, but as we know, these loans are more risky. That does make sense. But when we go over here to that early default rate, the trend still holds true, right? It's a 1.05% for loans produced in 2024 that defaulted in 2024. 2023 was a little bit higher, but if we go back pre-pandemic, you're really at similar numbers. So as far as an early default rate risk, the data is not showing yet that is increased compared to past SBA history.
Okay, interesting.
Yeah. Now, I mean, you're looking at 4.77% for loans in 2023 or 2024
2023, yeah.
2023. That's really
I was gonna say that is startling to see that. And I think that was some concern because that's also timed closely with the change of SOP in 2023. So, there were some significant changes that were identified at the end of 2022. And then when you see the 5010-7 coming out in early, or I guess mid 2023, there's a significant concern around the fact that is that as a result of people embracing those the additional risks that you were able to take in a sense because you had more freedoms in enacting the program.
And the guardrails off. Yep.
Exactly.
Yeah, I think it's a little bit of both, David, because I know that, I mean, those loans, so that was active, August 2023 was
Right.
kind of the place. I mean, that we only got a month of that in the 2023 data because it's fiscal year.
True.
So I actually don't know that it's that.
I will say that, but remember, scoring itself was opened up toward the end of 22, where you were officially able to make. And so, in theory, there could have been a good bit of scoring taking place in 2023, depending on how many lenders were really leaning into that.
Yep, that makes sense. Yeah, and again, it's still we are still seeing issues, right?
That's a good point, though.
Produced in 18, 19,
right,
20, 21. So it's just that it is. We've been fascinated by the data to say the least. It's been very
and
to look at.
I agree with Chuck's comment earlier that there's some thoughts. Is it just that there was so much support that was out there due to stimulus and other pieces, through the end of 20, and was it kicking the can down the road, or was it additional risk, a combination of both? It is interesting. I like the word you use, Cory.
Yeah. Chuck. So this was probably the main one that I thought would be good to show. It really highlights kind of where we've been. I mean, you can get in this all day and drill into specific industries and lenders and more, right? Is it a non-bank lender, credit union, bank, things like that? But the aggregate, I mean, it is true. We are increasing year over year for sure from a default rate standpoint.
Let's talk a little bit about, we had a couple conversations with the folks at Office of Credit Risk Management, and their reviews when they go out, they tend to be a little concerned. They talked about, some of the lenders aren't proactive in managing or servicing their portfolios. They're waiting for the loan to become past due. What's some suggestions to avoid that, guys?
David, you want to take it first?
Well, sure. That is not a new issue, I think, Chuck. When you get down to it, it is a combination of. I realize there used to be a rule that you had to prove that you asked for financial statements. I can remember being a part of many audits where we had to show the letters going out, and there was a ton of effort that went into making sure we could prove and sending out documentation to everyone. But the number of businesses that actually responded to that were pretty low. They typically were busy running their business, and that's what we wanted them to do, of course. So that is an interesting thing. But what we did find is that it was really about keeping the communication with those borrowers. Monitoring a loan and monitoring a customer doesn't necessarily have to look a specific way. It's certainly good. And I think now with information we can get, whether it be if you can see account activity, you can see payment activity, you can see credit history. You can sort of see the telltale signs that are out there that are going to be a lot better than a tax return that was sent, that was on extension, and by the time you looked at it, it's already over a year old. And don't forget, many of these businesses are aiming to minimize their tax liability, which means, and sometimes it's a darker picture than is reality, simply because they're taking advantage, and I mean that in a positive sense, of the laws that are out there. So I mean, their write-off says they should be written off, and so on, and so that can often lead into, well, now I have something I've reviewed, and now I have internal policies, and in a sense I have to follow. Because if I'm saying that the outlook of the loan is in question now because of the fact that it looks like debt service is tight, or maybe it's a little below that, but every other indicator I have says that it's good, including speaking with the customer and then telling me they're doing really well, it's the best year they've had. There's all kinds of ways that you can muddy this, and so in some ways I can understand why a lender was saying it's not past due. What exactly should I be doing here? And so to me, it's definitely something that shows a pattern of checking on these customers is where you got to start. Like there needs to be some apparent effort that you're doing something, whether it be looking at the payment histories, looking at the account activity, maybe pulling updated credit reports to see, are they paying everyone timely? If you're monitoring collateral, is insurance paid up to date? If there's any concerns around those sort of items, if all of that's in check and you are at least once a year having some sort of contact with them and they're indicating that things are going well, I imagine that's a lot better than not doing anything, just at a minimum.
Absolutely. One of the other points that they made was that the lenders that are now working at guarantee repurchases and workouts are engaging attorneys that just don't know SBA regulations. And that's been an issue that they've brought up a number of times. It's probably good to vet those attorneys that you're using.
Yeah, Chuck, the only thing I would add is just to everything David said, there's a lot of good third-party scoring out there now, including Redwood scored some of the SBA scores. We have a score as well. Just being able to have another data point to help predict that risk if you can't get access to financials or you can't get access to payment history or updated credit data, being able to at least pull something that is macro level, industry level from a risk standpoint. We've seen a lot of partners do that and have success of identifying early defaults.
Interesting. The other point, David, you and I have been doing the lender service provider work for a while. And one of the questions that we ask when we sign up a new client, are you involved in the lender portal? And sometimes they look cross-eyed at us. So it's almost like they're not using it. And that's a valuable tool. As Cory said, if you have the analytics, the lender portal is the window that the SBA looks into to see how the bank is managing their risk.
Right.
And if you don't understand it, if you aren't in there and not looking at it, that's an issue.
I completely agree with you, Chuck. And the thing is, whether or not the indicative score, however it comes up as you're looking at it, whether or not it's perfect directionally, it gives you a lot to think about. And so that's what's interesting. If you see something that appears to be an increased risk, or that it has moved in some way, or it has become a decreased risk, that's good. I mean, what caused it? If you can kind of take a look at that and see if there's trends underlying, that tells you a lot about your portfolio. And I also get it. Lenders can have anything from a portfolio of 10 loans, 100 loans, 1,000 loans. There's a tremendous difference in that. And what one person can know all 10 of those customers easily, and maybe you're talking to them once a month. You never know. So that's a level of monitoring SBA could only dream of, lenders having. And so obviously that's different. That's a different type of monitoring that's not feasible when you have 100 customers that you're trying to keep track of, and it's perhaps just one person doing that. So you have to find a balance in there. But to your point, that portal is a great way to give you a high-level snapshot, take a look at it, and what's changing in your portfolio. What's trending. That's the important piece.
It's helpful if you understand it, you can manage it. You can
right.
take steps to improve it, so you are looking better in the eyes of the SBA and the credit risk department. Cory, tell us a little bit more about the Lumos portfolio analysis that you provide, if you don't mind.
Yeah, so kind of back to, it's filling in the gaps of everything David just said that you should be doing, right? It is instead of that piece, it's just another add-on, right? So it is going to look at more, how is this industry trending as a whole? What's the macroeconomic environment like for where this loan's at? And really give you an indication of risk. How old is the loan, right? Age of loan matters a lot when it comes to risk. And when we see that with this data on the screen. So it takes all of those factors into account and weighs how those have performed historically and uses machine learning to predict out the next 12 months of risk for that loan. And then you get in like a dashboard where you can track all that. So it's by loan, but you can look and see, wow, the X industry is doing really poorly for us. We're predicted to have a lot of risk there. Maybe we have a concentration risk. Lenders are using it for things like that.
What information would you need from me to analyze my portfolio?
Yeah, it's pretty simple. We would need, the business address. We would need the current book balance, age of loan, interest rate, and then that's really about it. There's not a whole lot more. We pull the rest just from public sources when you think about all the macroeconomic data. But those are the main features that we would need about the loan to be able to pull that score.
Okay, thank you.
Yeah.
Well, I know we have checklists for underwriting. We have checklists for closing, and we live through those. David, tell me a little bit about some tools that you could use or we could use for portfolio servicing and portfolio management. Anything you can think of?
Well, again, it comes down to your checklist is only as good as the plan that created it in the first place. And
Yeah.
and again, it's not going to be it's not a one size fits all. You can't. Again, I go back to I've got 10 customers. I'm keeping track of them. That's good to have a checklist there to show sort of if there's an audit, if one of our friends from Okram is coming and wanting to ask you about it, you have a means of showing, well, here's sort of the monthly activity. Here's the things that we're looking at. Here's our quarterly activity. Here's our annual activity. There's the items. And so just remember, having a checklist for that is going to look very different than a bank that perhaps has 100 loans or more in their portfolio.
Sure. Yeah.
And so to me, it's an intentional plan. And remember that SBA, and so in the 5057.3.1, right, we're into December now. And so remember that one, it's you sort of have some freedom in how you go about doing that. And I would use that as you're preparing your checklist, right? So you're looking at it and make sure that it says, because I just think that servicing paragraph, it talks about different ways which include a scoring model that can be your primary basis for it. And I would do that to sort of build it out. I wouldn't just do that. You have opportunities where you're interacting with them. And I realize that to some extent, if you're only managing by default, essentially you've lost the opportunity to help them, to assist them. Sometimes businesses don't realize that you would prefer them to find a way to work the loan out. That seems simple enough to all of us who have been in the industry, but I guess not every business is going to feel that way. And so the idea of being able to reach out and remind them, like if there is a struggle, there's something happening, the sooner they're contacting you about it, the better, in terms of just your flexibility and the options you have to help them. Because most temporary issues can be solved, with either some sort of a deferment or modification to the loan, and the lender has quite a bit of flexibility with it, and I would say authority, and from a servicing perspective, and don't lose track of that. The SBA ultimately wants this loan to be repaid. We all win when that's the case, and so that's just, I don't know. That's what I would focus on. Be intentional about the plan. Make sure that you're following the letter and the spirit of SOP. When you're doing that, and then just kind of prove your work. It's not, even if you didn't document it, you didn't do it. And I know that's not reality, but that's what it can often feel like. And so a history activity you've taken goes a long way to proving out what worked well. Not to mention later, if there was a struggle, or if you're noticing some things that would have been good to know, a year ago, are there small changes you can make to your plan from a month to month that you're monitoring? If it's a simple matter of, if you weren't tracking insurance, maybe that is an indicator. And if it's not a large lift to do that, then do that. There's lots of, to Cory's point, there's lots of third parties out there that offer services or tracking or other items that might be a low lift that pay off big in terms of knowing ahead of time and how to help your customers. So those are all things to think about.
One thing that we haven't talked about that we're a big proponent of is external loan review, external SBA loan review. Most lenders will have a firm that will come in and do loan review for their conventional loans, but there's a handful of vendors out there that specifically come in and look at eligibility and loan review combined. And that way you can identify maybe some high risk accounts in your portfolio, making sure you've gotten all your documentation in, and engage one of these firms to come in and actually go through the file, which is most helpful, especially if you're using a third party like an LSP. It's a great
That's right.
way to have a good external control, and use someone like Cory's portfolio scoring, identifying some problem accounts, and then engaging one of these firms to come in and go through with a fine-tooth comb to make sure that the guarantee is in place.
Yep.
Yes. Yeah. And I go back to the large lender example, or say larger, not necessarily objectively large, but when it comes down to it, if everyone's always strapped for resources, and it's the servicing department that always has the hardest time with that. I don't. It's not as flashy or exciting, and so the thing I think about there is whatever means you're monitoring this, just being able to identify something is I can't reach out to all 100, but here's 10 I can focus on. So which 10 are you going to be picking? And having something to identify the higher risk, that's the way to go. That's the highest and best use of your time that you've got. And so something, again, like you're talking about, Cory, to me, that's such a great way to make sure that I'm spending the limited time I've got in the best place.
Yep.
Awesome. Cory, anything else you can share with us? We're coming up on our 30 minutes here soon.
Yeah, I mean, I don't know if there's a particular industry y'all would like to look at that you'd like to check in and see how that's doing. I mean, you can pretty much slice and dice this data.
Cory,
way.
I have a question for you then. So let me ask you, has there been a surprise anywhere to you from an industry standpoint that you perhaps you would have been surprised that one's struggling right now compared to historical, or anything unique in the post-pandemic world, right? That was, perhaps performed stronger, but has not now, or vice versa. I'm just curious.
Yeah, nothing that comes to mind, but that's kind of the beauty of these. We can try to find one, David, real quick.
Okay, I didn't mean I put you on the spot.
No, you're good.
I like looking at this, so I think the people that are listening will be happy that you're going through this. Please.
Yeah, no, this is great.
Yeah.
We can look, because it's not a surprise, but I mean, we did hear from a lot of our partners, right, that the trucking industry was struggling for them specifically, and it has.
Yeah.
And so we'll go to top industries here, and we'll just look at the last, 3 years of performance period and see, where we're at from a risk standpoint. We can go through and kind of together decide if any are pretty shocking from a post-pandemic world. So this is overall last 10 years, but we'll filter to the last 3 years, and then we'll see what's up there. From a default rate standpoint, you got any guesses, David, Chuck?
Well, now you put me on the spot. Yeah.
Restaurants.
Yeah. Well, yeah, I wonder how much that's changed. I mean, so much food is being delivered instead of being eaten in house, and so the restaurants that have these large dining spaces, are they hurting versus lots of other restaurants that it's just quick carry out or delivery? I'm curious.
Yeah, so we're going to need to do some sample size, because we don't want to just attack tobacco farming because they've had like one loan. So we'll say there needs to be at least 100 loans in the industry.
Right,
it's not two loans. Sorry, I undershot that a little bit, but we'll say there has to be at least 100 loans, and then this will give us the ones that have struggled the most. So I mean, travel agencies, that kind of checks out, right? I mean,
that makes sense. Yeah.
On vacation, economy's tighter. As we go through here, I mean, nothing truly stands out, but this is a good way to look at this, right? It's how you can use the data if you're not super familiar with a particular industry, being able to pull this up and say, hey, we just got a clothing and clothing accessory, and that one kind of makes sense too, right? People are ordering all their clothes online. Like, I don't think I haven't shopped in the store in 4 or 5 years now. So it's things like this, being able to see. And again, this is just the last 3 years how loans on book have performed in these industries. And then conversely, we want to go ascending. We can see, okay, which ones are doing the best. And that's the ones you might want to
focus on.
Yeah. So cemeteries and crematories, 113 loans, no defaults. I mean, that checks out. But like outdoor power
Outdoor
equipment,
power equipment. That's interesting.
it
I mean,
is, right?
everybody. One of the comments I saw that everybody was stuck at home when like household projects went through the roof during that
They
time
did.
period. That does make sense. Yeah, because you were
Yeah.
Bought
staring
my
at the
first
wall.
leaf blower.
Yeah, exactly. Exactly. And that checked out. So 0.27% default rate there. But yeah, I mean, you could kind of go down those. I mean, some of these have always been here, like vet services. Marinas is kind of interesting, too, I guess. I don't know. But yeah, you can get lost. I mean, we could spend another hour and a half looking at this, if probably just this list if we wanted to.
That is interesting.
Yeah, that was a good question, David.
Thanks, Cory.
Yeah, for sure. Yeah, I'm looking. Yeah, very cool.
Well, this has been most helpful. David, is there anything else we need to go over before we adjourn?
No, I don't think so. I think we covered everything. It
That's
just really
good.
boils down to, like we talked about, you need to have a plan. You need to follow through with the plan. Information's everything. Certainly better than not looking at it, or a plan is always better than no plan.
I think a couple of the upcoming webinars that we're going to have, January 23rd, our guest is going to be Jessica Kahn, one of the attorneys over at Starfield and Smith, and she's going to go over guarantee repurchases. So that kind of falls into place with what we're talking about today. And hopefully when the Redwood score comes out and they're actually promoting that, we'll have some information on that. Cory, anything else you can share with us that you guys are doing?
I mean, normal stuff. Yeah, we do have I think one of the best ways to manage portfolio risk is to score and get better information on the front end too, right? I know some things it's too late, but being able to just be more proactive, using tools, not just ours, but a tool like Lenders Cooperative or another loan origination system to speed up a lot of that tedious manual work so that your folks can spend more time actually analyzing data, I think is where we're seeing the market and the SBA as a whole go, which is super exciting. So I think there's a lot of good products out there to assist and help and get your underwriters and your credit team actually spending more time looking at the data instead of pulling it all together.
That's great. Well, David, Cory, thank you both for joining today. It has been most helpful. Everyone else, have a happy holiday, and we'll see you next month on January 23rd at 12 o'clock noon.